Good evening and welcome to everyone present on the call. I wish you all a very happy New Year from the entire team of Ramakrishna Forgings. I hope you all have got an opportunity to go through our financial results and investor presentation, which have been uploaded on the stock exchange as well as on the company's website. I am pleased to report that our company has a strong Q3 and 9-month FY24. I think someone is speaking. Everyone has to go on mute, please. The commercial vehicle segment, a crucial pillar of the national economy, is undergoing a significant transformation. This is fueled by technology, mega trends such as alternative fuels, electrification, and industry modernization. Factors such as the surge in online retailing, government policies, logistics services, and expanded network of improved highways, industrial growth, all this contribute to the steady growth of this segment. We at Ramakrishna Forgings are flexible and we consider ourselves an organization that thrives on challenges. We take advantage of opportunities that come our way, such as expanding our business, improving productivity, and making sure our customers are satisfied. We have become an important part of the global market, even though the world economy is little weak right now. The good news is that things are getting better with time, and we are committed to gaining more customers and getting ready for business growth when the market conditions are improving. We are also increasing our capacity to support this growth, and as a company, we are prepared for the future. Over the past months, we have achieved significant milestones that have further solidified our position in the industry and propelled us towards the greater success. First and foremost, we successfully raised Rs 1,000 crore to the QIP, which received an overwhelming response from the prominent domestic and foreign institutional investors. The fundraising marks a significant step in our company's growth, allowing us to reduce debt and advance manufacturing initiatives. The support from the investors reflects their confidence in us, reinforcing our commitment to sustainable growth. During this quarter, we successfully secured approval from NCLT Delhi for the acquisition of ACIL Limited. This strategic move consolidates our foothold in the industry, promising a collective alignment of capabilities and resources, further enhancing our manufacturing strength. Furthermore, our aim is to create a sustainable future clean energy initiative. To achieve this, we took steps towards carbon neutrality by investing in renewable energy. We partnered with Concall Green Energy to install a 7.82 megawatt solar rooftop power project. We believe in the power of clean energy to drive positive change, and through initiatives like these, we can create a more sustainable future for generations to come. In line with the industry, we have seen an increase in demand as well for our products and services, which has led to significant growth in our revenue and profit. In Q3 FY24, we recorded a revenue of Rs 902.9 crore on the standalone basis, which represents a year-end growth of YoY growth of 20%, while for 9-month FY23 we recorded revenue of 2,603 crore, and for this 9-month it is standalone 2,603 crore, which again represents 20% year-on-year growth on the 9-month number also. EBITDA margin for Q3 FY24 stands at 22.98% as compared to 22.1% in Q3 FY23. The EBITDA margin expanded almost by 90 basis points, and overall EBITDA margin for 9-month FY24 stands at 22.80% against 22.2% in 9-month FY23. And the total expansion was almost 60 basis points in 9-month period. And we are confident of sustaining the margin of approx 23% plus in the coming quarters. Our net profit after tax is 82.3 crore for Q3 FY24 against 57.6 crore in Q3 FY23, which is a year-on-year growth of 43%. Our net profit after tax is 238.8 crore for 9-month FY24 compared to 168.8 crore for 9-month FY23, which is again a year-on-year growth of 41%. The strong performance is a reflection of diligence and commitment of our team, as well as the continued support of our customers and stakeholders. We remain committed to innovation, operational excellence, and customer satisfaction. We will continue to invest in advanced technology, enhance our manufacturing capabilities, and strengthen our relationship across the industry. With the foundation we have built and the achievements we have accomplished, I am confident we will continue to excel and thrive in this dynamic and competitive market. Thank you for your continued support and for joining us today. We will now take questions from the audience. Thanks.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Raghunandan NL from Nuvama Institutional Equities. Please go ahead.
Congratulations, sir, on stellar results and successful completion of QIP. Sir, my first question was on the domestic revenue. There is a growth of 32% and underlying domestic MHCV production has grown by 9%. The beat versus the underlying industry, what has led to this? Is it execution of new orders in auto, and which segments in non-auto has done well?
Good evening, Raghu. I think in terms of the overall domestic business growth, our railway has grown. If you see the presentation, railway has grown. Our revenue in railways have in this quarter been much better than earlier quarters. And also off-highway domestically has done extremely well. And in automotive segment, we have gained market share as well as we have gained new businesses and new components within the content. So all together, it has led to the growth in the domestic segment.
Got it, sir. And in the presentation, when you are explaining about the non-auto segments, there is one portion, others, which has also seen a big growth. Within others, what are included, sir?
Steel, cement. In other steel, cement, then this coal washery segment, all these industrial products basically are in the others.
Got it, sir. And, sir, going forward, will there be any temporary issues for dispatches, or will there be any increase in logistics cost due to the Red Sea issues? And also relating to that, this logistics cost would be a pass-through for you, and how much would be the lag?
No, I think right now, Raghu, we are still working on it. In logistic cost, most of the cost related to our Europe dispatches have been impacted. For US dispatches, we have not been much impacted. We are still speaking to the customers. In terms of our agreement with the customer, we don't have any such pass-through system of increase or decrease in the logistic cost. But while during the first phase of the Ukraine war also, when there was a considerable increase in freight cost, our customers cooperated and had shared the cost. We are similarly working with the customers to share the increase, and I think we will have a positive outcome, but it may take a month or so before we have any answer to it.
Got it, sir. And in terms of FY24 and 25, Lalit sir, can you give some guidance on the investments and capex?
I think if you go presentation, we have already guided for a considerable increase in our forging capacity. We have announced a setting up of 8,000 ton press in FY25, and which will be operational by December 24. So, and basically overall budget in terms of capex is yet to be released, but it will be in line with what we are doing in this current financial year, of close to 400 to 450 crores in the coming year also.
Got it,
sir. That will take care of investment and capex all together should be in the 400 to 454 region for the FY25.
Got it, sir. Got it.
We are not taking anything related to standalone now. At a console level, we will be spending close to 400 to 450 crores in terms of our capex.
Got it. And sir, my last question on new acquisitions. Multitech, JMT, ACEL. Can you provide some detail on current revenue profitability and also any order wins here which provides better visibility for future?
I think in Multitech Auto, we have already provided in our presentation. We have got full quarter of revenue of 92 crores almost from Multitech Auto. And already it has seen a 200 basis points EBITDA jump since we acquired. I think previously MAPL Multitech Auto had an EBITDA of around 14%. And we have already had much EBITDA efficiency and almost 16% of EBITDA. And we are aiming to improve the capacity from current 24,000 tons to 70,000 tons by the financial year end of FY25. And we are looking at almost 600 to 650 crores revenue from Multitech Auto in the coming year.
Got it, sir. This is very helpful.
Around 18% EBITDA, we are aspiring to achieve 18% EBITDA from our casting business.
Got it, sir.
And regarding GMT Auto also, we have given a complete line. I think this quarter we will have no revenues from GMT Auto. And first quarter onwards, we have given a guideline by when we are starting the forging and other things in GMT Auto post refurbishment. And we aim to have 400 to 500 crores revenue from GMT Auto by FY26. ACIL acquisition has been completed in the month of January this year only, and I think it currently has a revenue of close to 4.5 to 5 crores on a monthly run rate. That means 15 crore rupees per quarter. I think customers are intact as well as the plant is up and running. So we are going in for extensive refurbishment on that plant. So we are hoping that next year in FY25 we should do good revenue with good EBITDA from the ACIL. I think we will be able to better explain ACIL revenue in the Concall we have post the full year results.
Got it, sir. Extremely helpful, sir. Thank you so much. I'll come back in the queue.
Thank you. We'll move on to the next question. That is on the line of Mumuksh Mandlesha from Anand Rathi. Please go ahead.
Yeah, thank you, sir, for the opportunity and a good set of results, sir. Sir, in Q3, the export growth has slowed down to 4% YOY. What has led to the slower growth, and how do you see the outlook ahead?
YOY is the growth. Sir, YOY we have grown in export by 4.1%. Here, basically quarter on quarter there is a decline. But YOY, I think we have grown by 4.1%. In exports.
Yeah. So compared to previous quarter, growth has come down. Just want to understand what.
See, that is a phenomena every year. I think third quarter, because of the Christmas holidays and other things, the inventories at most of our exports in Europe and US, there is less of consumption, and we are back on track in this quarter onwards. So basically, if you see every year, fourth quarter and the first 2 quarters of the financial year do extremely well. Third quarter is almost every time flattish or there is a degrowth quarter or quarter basis.
Right. Got it, sir. Sir, on this new press of 8,000 tonner and also some small presses, just want to understand the capacity is significant increase of around 40,000 metric ton. So can you indicate what kind of small presses are there, sir?
No, basically we are installing 4,000 ton press and 2 small presses in warm and hot forging. So 8,000 press itself will give us close to around 32,000 tons of forging.
Okay. And what kind of revenue potential from this capacity would be there?
So if you see, go by the average realization also of 2 lakh rupees, 40,000 tons at 80% utilization also can give us close to 600 crores of revenue.
Got it, sir. Thank you so much for the opportunity.
Thank you. The next question is from the line of Vishal from Swan Investments. Please go ahead.
Thank you for taking my question, sir, and congratulations on great set of numbers. Sir, I have one question regarding what is the outlook we are seeing in terms of both domestic market as well as exports in the near term as well as for FY25 period?
I think the environment is challenging, but as in terms of customer and content gain, at RKFL we are doing extremely well, and we continue to thrive on our potential and new order wins and converting these order wins into new supplies. And I think the guidance which we started with in the first quarter of financial year FY24, I think we are well on track to achieve our numbers or surpass those numbers.
Okay. On the volume terms, we'll be able to surpass these numbers in FY25?
I think right now we are at FY20. We are still to complete FY24. I think once we complete FY24, then only we'll give guidance for FY25. But we don't see any downtick in terms of our utilization or overall sentiments in the market. We see that market is going to remain strong and robust, and we will continue to excel on the capacity which we are implementing.
Okay, great, sir. Sir, my second question is regarding, thanks for sharing, inputs on JMT Auto. Sir, wanted to have some inputs on what would be the margin trajectory and what is our aim to take this margin in next 1 or 2 years for JMT Auto.
JMT Auto, I think in this year we cannot predict the margin because the capacity is still going to get started, and we hope to achieve only 150 to 200 crores of revenue from that. But by FY26, when we are starting getting 400 plus revenue from that, we are looking at almost 25% margin from that.
Great, sir. Okay. That's all from my side, sir. Thank you and all the best.
Thank you. The next question is from the line of Mitul Shah from DAM Capital. Please go ahead.
Sir, congratulations on strong performance and thank you for opportunity. Sir, my first question is on this outperformance, follow-up to previous question of Raghu. Despite production slowdown in MHCV, more than 20% outperformance we achieved. So do you think, sir, this type of outperformance will continue, and any specific this quarter-wise one-time impact in this quarter, or sustainable 20-25% outperformance possible for next 2-3 quarters?
Thank you, Raghu. Thank you, Mitul, for this question. I think at RKFL we are in for a long run and we continue to outperform the market, and I think we are looking at a long-term sustained growth rather than one-time growth. So whatever our figures are or whatever growth we have, you are seeing it will be a steady and stable and sustainable growth.
So this healthy double digit will continue even if industry may undergo some slowdown in FY25.
As far as we are concerned, we don't see any slowdown in RKFL.
So second question is on this 25,000 tons warm forging, cold forging. So how the ramp up can we expect? It will be like a full ramp up by second half 25, or it will be relatively slow and 26 will see full capacity utilization? Because we already have some pre-orders for this specific capacity, right?
We already have a full order on this. But in terms of sample making and sample dispatches and sample approval, you will see full utilization of this entire capacity from fourth quarter of financial year FY25. And but you will see considerable utilization starting third quarter, and fourth quarter should show you almost 90% plus utilization in this capacity.
So lastly, on this ring rolling, in our presentation we have given almost 150% utilization for this 24,000 installed capacity. So up to what extent this utilization can further increase, or this is the optimum? And despite every time it's coming 130, 140% type of utilization, we are not increasing any capacity here. So any specific reason behind that?
to increase any capacity in terms of OEL because we are almost at peak market share, and as well as we are able to utilize, get premium from the customer on this parts. But we are working on a lot of VAVE activity in terms of re-engineering the entire line. And very soon, with the kind of automation or other things we are doing in this line, our capacity in this line will go up to 30,000 tons, which will basically bring down the utilization from 148% to 110 or 115%. But we are not in any way increasing the capacity or adding any further equipments for ring rolling. We would or spending any large capex in building up capacity for ring rolling.
So, sir, just follow up that with 30,000 capacity, what could be the maximum output possible, or what can be the 150% type of utilization is possible in case of huge demand?
No, I think utilization level 148, what you are seeing, will drop to 110 or 115. But overall, I don't think we will be able to go anything above 30,000%.
35,000 may do.
35,000 tons is what right now what we are achieving. That is only what we will be achieving.
Thanks, sir, and all the best.
Thank you. The next question is from the line of Jaimin Desai from Emkay Global Financial Services. Please go ahead.
Yeah, hi, sir. So you alluded to tough external environment. Can you please give some more color around this? Where exactly is the softness that you're seeing? I understand that we have very strong growth drivers for our own business because of order wins, etc. But just with relation to the environment, where exactly is the softness that you're seeing?
No, we are not seeing any softness related to our business. So in external environment, I think this war and this disruption due to this Red Sea and all other things are an ongoing affair right now since last 1.5 years. We are bearing the brunt of it. First Ukraine war and then now this Red Sea disruption. But I think in terms of softness, we don't see any softness. While market may not grow, but we don't see any softness in them with the kind of order wins we have had and the pipeline which we have right now for new order wins to come in the next couple of quarters. We don't foresee any slowdown in terms of our offtake or our growth plans getting hit by any external environment as such.
Okay, so even in the case of, let's say, North America Class 8 truck market, you do not expect any growth challenges in next year or maybe beyond that for the market itself?
Slowdowns in last 1 year, but in terms of my balance sheet or my dispatches or my customers, we have not seen any effect in terms of our calls for our new dispatches. So we will not be able to exactly per se say what is happening in the Class 8 market. But overall, we see no slowdown in terms of demand. I think the market is pretty stable, and we are doing extremely well with the kind of new content and new orders we have in our pipeline.
Understood, sir. Very encouraging. Thank you.
Thank you. The next question is from the line of Chirag Shah from White Pine. Please go ahead.
Yeah, thank you for the opportunity and congratulations for a good set of numbers, sir. Sir, first question is just a simplification if you can help us. So from, say, current revenue that we have, and I'm just annualizing the 9-month number, if I have to take a 2-year view, what is exactly the capacity or revenue capability that we have on standalone as well as at consolidated level, either in terms of revenue or in terms of the tonnage, however you would like to highlight. So if you can first help us understand standalone, because there are too many projects which are coming. Some are coming in standalone, some are coming in consolidated. So if you can help us a bird's eye view, it will be helpful, sir.
Chirag, I think it is very difficult for me to put any number to what future guidance is. We will be more upfront post full year results, but we can very confidently tell you we are looking at 15 to 20% volume growth in our overall balance sheet. Overall business is concerned. we are looking at 15 to 20% volume growth.
Yeah, and would it be right to assume that this 15-20% volume growth would be more driven by subsidiaries given the ramp up that we are looking at over there? Given I'm putting JMT, ACL, everything over there.
No, I think every balance sheet has its own potential to grow, and they all are 100% subsidiaries of RKFL.
Yeah.
We are overall at a consolidated level, 15 to 20% volume growth, which standalone RKFL will also deliver, and in terms of other balance sheets also will deliver. So overall, at a console level also, we are looking at almost 15 to 20% growth in the current phase. That's the guidance we started with in April 24, FY24, and we still maintain that guidance. And I think any revision in terms of guidance upwards or we'll be able to come with more certain answer post the full year results.
Yeah, and sir, if possible, at the end of the year, just a capacity ramp up in terms of production capacity ramp up, if you can indicate, it would be helpful, because your capacity seems to be growing at a reasonable fast pace. So you are ready for a 50% kind of a growth over the next 2 years once this program, the capex program, that's done over the next 12 months, bare minimum. So that's why I was asking, wanted to understand the capacity ramp up. If you can explain it later on, it will also fine at the end of the year.
Chirag, if you go by the presentation, each and every company's potential and the revenue potential and by when we expect things to happen, I think company-wise we have very clearly mentioned in the presentation. However, we take your suggestion, and I think we will try to more be certain with what is there in full year.
Yeah. And sir, second question was on JMT. So you, from say 200 odd crores this year, when I say this year, next year, at 25 to 600 crores revenue indication that you had, it implies that there are approvals in place, the capability, once you put the capex in JMT, it's more about delivery rather than getting customer approvals. Or is it the right way to look at it?
I think, Chirag, we are already in with the capex in GMT. 3 months have passed and another 3 months to go. I think first, from mid-April, I think FY25 we will start production in phased manner in GMT, and that's the reason we have indicated 150 to 200 crores of revenue this year. And potential of this plant is to reach to anything between 500 to 600 crores revenue.
Okay, fair point. It's more about potential. Fair point, sir. This is helpful. This is helpful.
Yeah. We have customers in place. In terms of approval, we need to go for reapproval, which we have already started, and we are already in discussion with the customers.
Yeah. Thank you. Thank you very much, sir. And all the best.
Thank you. The next question is from the line of Abhishek Jain from Dolat Capital. Please go ahead.
Thanks for the opportunity. Sir, my question is regarding that railway business. So what kind of the revenue you are projecting in FY26 or FY27 from this business, and what would be the EBITDA margin from this business?
Which railway business actually? There are couple of, you want to know about any particular business or railway as a whole?
Railway wheels.
Railway wheels, I think it is still very early for us to tell you. I think the plant is going to, if you see the presentation, only by FY26 end, the plant is going to get commissioned and start. So I think it's too early for us to tell you what is the potential revenue and EBITDA from that plant right now.
So what is your target ROC for that business?
ROC, we are looking at 4.5 to 5.
Okay. In initial year, right? Okay. And my next question is related with this carbon emission norm that is going to implement in UK and other European countries from 2024. Hello?
That is only for steel sector, sir. For forgings and other things, it is 2027.
Okay, so there won't be any impact of this in 2024 related with the sourcing of raw materials or anything else?
Nothing. I think it is related to only steel, and for forging and other things, it is 2027 January, and we are getting prepared for that.
Okay, sir. Thank you. Thank you so much.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is on the line of Jaimin Desai from Emkay Global Financial Services. Please go ahead.
Yeah. Sir, can you throw some color on the growth opportunities in non-auto side? For example, in railways apart from the wheel project and in areas like oil and gas?
I think in railways, we are looking at almost doubling our revenues in next 2 years. From where we are right now, every year we will be almost doubling our revenue from railways. And I think railway with the kind of modernization which is happening in India, I think sky is the limit, and it is up to us how much we can encash this opportunity in delivering the right parts to the railways and finding right opportunities within this modernization. So we are working very diligently with the railways, and we are trying to encash these opportunities. And right now, putting a number specific in terms of growth, it is very incorrect. But I can only tell you that the way things are shaping up and way the demand is shaping up, doubling our sales to railways is a very small thing which we are talking about. I think opportunities are much more in terms of how we are able to deliver and encash the opportunity.
Understood. And in oil and gas?
Oil and gas also, it is steady business for us. I think right now we don't see any exponential growth in oil and gas, but it is a steady business wherein we have been able to continue our steady operations. With GMT coming in, with the businesses with what GMT was doing in oil and gas, I think that place wherein we are going to grow very fast, and that is going to be an additional revenue in oil and gas from North American customer, which GMT earlier was doing. Close to that was an 100 crore plus business which GMT was doing. I think we are getting that customer back very soon, and that oil and gas business from GMT will be a big business which will be consolidated in the balance sheet of our case.
Okay. And from a margin and return ratio point of view, non-auto segment would be comparable to autos?
I think non-auto is obviously a better margin game, and as our non-auto businesses continue to improve and in terms of percentage to our sales, our profitability should grow.
Understood, sir. Thank you.
Thank you. The next question is on the line of Vidram Mehta from ASK Investment Managers. Please go ahead.
Yeah, thank you for the opportunity. Sir, post the QIP money, what would be our current gross and net debt?
So as on they become 593 crores is the net debt, and by March it will be less than 500 crore.
Okay. So secondly, of the 20% growth, top line growth on the standalone business which we clocked for Q3, could you help us in terms of understanding the bifurcation with respect to pure volume driven growth, or from new products, or from market share gains from the existing customers? Like can you bifurcate that 20%?
It is very difficult to say what market share came from what customer or whom, but in terms of new components, I think almost growth for 5 to 6% has come from new businesses which we have won in domestic industry in terms of our content. And exports have been steady. Exports, I think if you see year on year 4.1% we have grown in terms of exports. And that also largely driven by new customers wherein our supplies have started in this quarter. And in this quarter, you will see further gains coming in with this place. And I think overall in terms of market share gain, it is very difficult to tell from whom we have gained market share. But we are continuously working with customers to get into new product lines and new contents. And both in domestic and in export. And in domestic industry, things turn around very fast. Because of our local presence as well as our foothold into and the relationship which we enjoy with the customers.
Right. So, would it be, safe to assume that roughly 5 to 6% is the new business growth which we achieve on an annualized basis? And, new order wins also helps us in terms of, booking the revenue. Apart from the organic MHCV growth, which the industry clocks?
No, I think this industry growth, I think it is very difficult to say how we grow against the industry growth. But in terms of existing component, we have been able to gain market share. New component, which I said 6% is absolutely a new, like for MHCV, we have started manufacturing suspension components. So these are the sectors which we are entering new in terms of forging. So this is the 6% which we are getting. So obviously, the existing components, we have been able to increase our portfolio with the customers. Also with the new content which we have been able to create in terms of forging, that is helping us in terms of our overall gain in terms of the overall, if you see 30+%, that is the reason we have got.
Okay. So secondly, on the domestic MHCV front, we keep on hearing that after 2 or 3 years of a good MHCV growth, in the domestic business, expectation is that for 25, probably we could see a flattish to mid-single digit growth for MHCV. But, in terms of average tonnage, it is going to go up. So, number of MHCV sold, could be flattish, but in terms of tonnage-wise, the carrying capacity could be higher. Given that situation, would our tonnage be better in terms of, growth for 25? So should we look at absolute MHCV number or should we look at tonnages for reflecting the growth?
I think the best way to look at it is the tonnage growth, and I have been always telling that number of, with the way right now the freight is moving around in India and with the kind of vehicles which are being built, multi-axle and high tonnage vehicles will be sold more and low tonnage. So unit numbers will not define anymore. Growth is going to be determined with the...
Sorry, sir, we can't hear your voice.
Hello?
Yeah. Yes, it's better.
So I think with the overall, what we feel that overall tonnage growth is going to be the way forward to look at the growth in the MHCV industry. And if the tonnage grows, we will continue to grow because the requirement of number of axles will increase with the high tonnage vehicle.
Okay. And so lastly on the restructuring part, wherein, we are doing some, we are going to acquire a land of, Mal Metallics Private Limited, which is a step-down subsidiary. And we intend to commence a trailer axle assembly over there, which will help us in terms of, getting some operational efficiencies. Could you throw some color on that, on the qualitative as well as on the quantitative front? How much benefit could we get out of that?
No, I think these are all 100% subsidiaries and we are going for large-scale restructuring. I think in February you will hear much more in terms of restructuring. We will not be maintaining so many subsidiaries like ACIL, GMT, Multitech, Mal Metallics. So this is only the first phase of consolidation which is happening. But the overall consolidation in terms of ACIL getting merged in RKFL or GMT getting merged in other subsidiaries, we will only be carrying 100% subsidiary of RKFL, which is going to be the casting business. And the rest, all the businesses are going to get merged in RKFL very soon. So so this is first part of restructuring which we have done. I think overall restructuring you will be doing by end of February, in which only we have 100% subsidiary of RKFL, that is the casting division.
Okay. Sir, can you share the breakup in terms of revenue from the subsidiaries for this quarter? Like, standalone we already know, and consolidated we have the number. The difference would be from the subsidiaries. So subsidiary-wise revenue, if you could share.
I think Multitech Auto is close to around 92 crores.
Okay.
And then
okay, sir, thank you.
LLC around 20, RKFL LLC around 29 crores.
Okay.
And Globe is around 60 crores.
What happens that RKFL LLC being the goods being supplied from RKFL India, so a lot of it got eliminated. So overall number get eliminated by 25 to 30 crore in entire consolidation. So that's why the number is, whatever you add up, it will come at 1087, but actually it will be 1057.
Okay. Okay.
At the consolidation level, LLC numbers basically are getting knocked off because of Ind AS. So basically 1050 you are seeing and around 29 crores getting knocked off, which remains as inventory in LLC.
Okay. Thank you, sir. Thank you for the opportunity.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in this conference, we request you to limit your questions to one per participant only. The next question is from the line of Mitul Shah from DAM Capital. Please go ahead.
Sir, thank you for the follow-up opportunity. Sir, my question is on, as we almost completed all these 3 acquisitions and majority of the payment is done, so what would be the investment amount for this FY24? And at the same time, on CAPEX also, we have done majority of CAPEX also, capacity expansion in this year. So what would be CAPEX for this year, and next year would be purely maintenance CAPEX or anything meaningful apart from that?
Still, I think overall, CAPEX this year should be approximately around 450 to 460 crores in FY24. And in FY25 also, if you see our presentation, we are setting up a capacity for 8,000 tons press. Also, we will require maintenance CAPEX both in ACIL and GMT on an ongoing basis, and the casting capacity which we are fresh augmenting. So overall, we are looking at similar CAPEX from free cash flow of around 400 crores in next year also.
So just clarifying this.
And I think we will be able to give you some exact numbers once, I think on the full year results, once we finalize our entire budget in terms of overall free cash flow, what we are having and what is the CAPEX spend out of that free cash flow.
Just for clarification, this 450, 460 crores this year is including investment, right?
No. So the 450 crore is on the only CAPEX investment. This year is separate because you can understand 200 crore already we paid for Multitech, 125 for JMT, and there is an investment in the rail wheel project to the extent of 70-75 crore. So 400 crore already in terms of investment without ACIL, I think we have done this year, and another 450 crore in terms of CAPEX. So altogether it is 850 for this year. From next year, it will become 400 to 450 for the CAPEX and investment together.
Okay, sir. Thanks a lot.
Thank you. The next question is from the line of Sagar Sahu from Jefferies. Please go ahead.
Thank you for this opportunity. Just wanted more information on what is happening on the electric vehicles front. I understand that you were looking to develop some electric vehicle specific components like e-axle, and you had also invested in an electric vehicle component startup. So any more information that you can give us on that front?
So I think we are doing almost 3 to 3.5% of our revenue from EV, which we are supplying to overseas customers. But basically they are undercarriage components. And developing our own motor controller and e-axle with transmission, this is R&D which is ongoing. I think motor and controller company we have acquired, that is CEO, which is a startup company. And we are already working on in terms of our own transmission and e-axle. I think in next 3 to 6 months time, I think you will hear more about it in terms of, right now it's all on trial stage, vehicle trial stage. So we don't have a concrete answer in terms of the size we can achieve in terms of market cap, market size we can achieve in this. So once we have the trials and other things through from the vehicle, then we will be able to give you more color into it. But our aim is in next 2 to 3 years to develop the entire motor controller e-axle along with the transmission and as a kit supply to the 3-wheeler and 4-wheeler market.
Understood. Thank you so much.
Thank you. The next question is from the line of Darshika Khenka from AV FinCorp. Please go ahead.
Hello, thank you for the opportunity. So, sir, as far as I understand, our margin expansion in FY22 and 23 was a combination of two factors. One being the operational, things that the company has done, and also the tailwinds from the industry. Would you be able to bifurcate and sort of help us break down that how much has come from tailwinds and how much from company-related efforts, and how much of that basically would be sustainable? What I want to understand is that once this industry tailwind goes away, would our margins fall?
I think in terms of margin, I cannot give you anything related to what is tailwind and what is... but if you see constantly for 16 quarters, we have been maintaining a margin of 22% and above. And I think very slowly but steadily we are working towards our goal of 25% margin. And that's the way we are developing our own components, or the utilization of our plants are being worked out accordingly. I don't see any headwinds to our margin trajectory, while we do not say what is a tailwind which can happen to it, but I can very safely say that we aspire to be a 25% plus EBITDA margin making company, while we will be able to safely maintain the current margin trajectory going forward.
And I had one more question. What was the capex that we've incurred for the warm forging expansion?
So warm forging, we have already done the capacity of 10,000 ton. Right now, what we are putting up a small capacity of about 3,000 ton on the warm forging. And the capex has already been completed. I think we are going to commence the line very shortly.
Okay, can you help me with the capex number on that?
I don't have right now the specific number on that line, so we can clarify that also.
Sure. That's it from me. Thank you so much.
Thank you. The next question is from the line of Rakesh from Bahana Equity Advisors LLP. Please go ahead.
Yeah, thank you for the opportunity, sir. Can we know our current order book?
So we don't have any order book. We work to schedules, and I think from our export customers we get 6 months forward schedule, and from domestic customer we get 2 months forward schedule. And we work to schedules only, and we do not have a particular order book. We have only order book related to our railways, which is close to around 250 odd crores right now from railways. Other than that, we do not have any firm order book from automotive sector or highway. We work to only schedules received from customers.
Okay, thank you so much, sir. Yeah.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to Mr. Rajesh Mundhra for his closing comments.
Thank you. I take this opportunity to thank everyone for joining the call. I hope we have been able to answer and address all your queries. For any further information, kindly get in touch with us or our investor relationship advisors. Thank you very much.
Thank you, members of the management team. Ladies and gentlemen,